Hi, and welcome to our feature keynote interview for Emergence 2022. We're joined by the most prominent angel that I know on the planet, Mr. Jason Calacanis, who's the founder of Launch, host of This Week in Startups, and also host of the All In podcast, and also the Syndicate. Welcome, Jason.
It's a pleasure to be back.
I'm very happy to have you back. And I was just thinking about I remember our chat from last time, and we were sort of making predictions around COVID and how that was going to play out. And geez, what a surprise that ended up being for the year.
Pretty crazy. It certainly has changed a lot about how we do business in Silicon Valley, and that's something we could get into.
Definitely. Now, obviously, there been a wild start to 2022. It's fairly obvious. And I thought before we get into the fun stuff, sort of talking about what you're looking at and so forth, I'd just love to understand from your perspective as an investor, like what are you identifying as the risk factors when you're thinking about your own investments, your own portfolio, and how you're sort of processing what's happening at a macro and also, just in your own country?
Yeah. So there's always going to be macro events going on. The world is very dynamic, and we all know every hotspot in the world. Hopefully we don't have something that's a global pandemic again, but obviously we have the situation in the Ukraine, situation with inflation. And then previously we had our real estate bubble here. There's always something going on. And what I found I'm in my second decade now of investing in startups, and my third decade as a business executive is, the great companies are built through down markets, up markets. In a down market, they gain market share. They have to be a little frugal, more focused maybe, but they're gaining market share. In a hot market, they're dealing with a lot of noise and competition for employees, for marketing spend, and for customers. So there's a silver lining, and there's pluses and minuses to each type of environment. The thing that does not change is great founders starting companies that have awesome teams, a great product, and that delight customers. And, I'm over 300 investments now, and you can really start to get some philosophy or signaling after you do this for a decade. And the signaling I've learned is, great teams make great products that delight customers that become addicted to those products, which then generates revenue, which allows you to expand or upgrade the team and allows you to build a better product. If you can stay focused on that flywheel, everything works out just fine. And the problem is sometimes in a hot market like we're in, or in a crash like we're also in, it's like both things in the same year. Yeah. You can see people get distracted, wildly distracted. And sometimes there becomes a disconnect between the value of a company and maybe their execution level, what they've achieved. And so when we saw that happening over the last 3 years, we realized, wow, some of these valuations, $50 million before they have a product, or $25 million, and it's, they have 3 employees and a prototype. Sometimes that would make sense if it's a serial entrepreneur who's got the greatest prototype in the world and it's groundbreaking and there's a competition. Sure, that can happen. But when we start to see that become the standard, we looked at it and said, maybe we should take all of the companies in our portfolio and help them raise money since the market is so hot. And so we slowed down on new investments. Actually, we probably did the same. We didn't increase the number of investments is the way I would say it, because we were, really increasing the number of new investments we do every year. And we just started a little SWAT team inside of our company. And we put one of our managing directors on and said, talk to every founder, ask them what their funding plans are, and let's start doing some analysis of that. And we would have 50 to 60 of the 300 plus companies we had invested in raising money at any point in time, and probably 200 of them were active. So 25, 30% of them raising money actively at a time. And every time 5 of them would finish their financing, 10 more would be on top. So we got to a point where I think the peak was like 62 people were raising money. And so we just started really dialing that in and helping them raise money to take advantage of a very hot market where funding was a little bit easier, valuations were high. Maybe they could put a little cash in the tank and then deploy it if the market ever came apart. Now the market has come apart. And so here we are. We're looking at opportunities at maybe the valuations are coming back down to normal. The people who were able to close in that
It'd be great to give a context of what you see as the high valuation versus normal now, because I think that provides a real, because as you know, with founders, sometimes, they feel that, that they go through a bullish period like that, like what we sort of experienced last year. And as you know, sometimes they're not changing their valuation to reflect what's happening in the market. So some sort of perspective about how that's changed would be great.
Sure. And just as a preamble here, founders should go for the highest valuation they can get and raise as much money as they think they need to that they can successfully deploy. So don't mind anybody getting a high valuation. The market is the market. If the market is running a little hot, people can pick and choose what investments they want to make. So I don't blame anybody for doing that. There are things that can happen that can get you caught in a little bit of a valuation trap. So we'll talk about that in a moment. But to your original question, when I invested in Uber, Thumbtack, Calm, Density, all these great companies, they were $4 or $5 million companies in their seed round. Now seed rounds tend to be $10 to $20 million. I would say most often 8 to 12. And there was a moment in time, a lot of the companies coming out of Y Combinator were kind of trying to one-up each other and beat each other's valuations and trying to get to 15, 20, 25, $30 million and raise $5 million in a seed round. 15 years ago, an A round was $3 to $5 million. So now we have seed rounds, no governance, nobody's taking a board seat, no lead, party round. And that's a bit of a recipe for disaster, because then when the market corrects, in order to fill into let's just pick a number, $30 million valuation, in a corrected market like we're seeing now, you would probably get 10 times your top line, maybe 20 or 30 times your bottom line, your profit. So a $30 million company's probably got to be making $3 million in revenue, $250,000 a month, $250,000 a month. That's not impossible to do. It's quite possible, but you just may have raised that at a $30 million valuation before you had even a product in market. And that $5 million got you to maybe the first 2 quarters of having the product in market, 18 months or something on your plan. And now you're in that valuation trap. Now people might value the business. If, let's say, you just got to 1 million in revenue, they might value the business at 15 million, 15 times, very generous top line revenue. And so you raise that 30. Now you can clear market at 15 or 20. What happens? Well, you have a down round, and sometimes that's fine. The founder can spin it. The existing investors maybe participate, maybe they don't, but it can cause a lot of gymnastics in terms of legal, in terms of signaling to the market. And sometimes it can be looked at as a debt spiral. You raised at 30, you could only raise at 15 now. What a failure. And in fact, raising at 15 might have been a huge success 5 years ago. So there are these kind of things that can happen. And especially in the late stage where you had new private equity, hedge fund folks coming into the market and saying, we'll pay 50 times, 75 times next year's revenue. And so maybe a company with 10 million in revenue raised at 500 million, got 50 times, or they were, 50, they were going to do 10 million next year and they did 4 this year. So now they're getting 100 times last year's revenue or more, 125 times and 50 times next year's revenue. That can be a real trap. And if they had a burn rate where they're burning, let's say they raised that $50 million and they're burning 5 million a month and they've got 10 months of runway, man, shifting gears and laying people off and then trying to fill into that valuation will take a lot of consideration. And then everybody's got to kind of wait for the company to live up to that $500 million valuation. Again, it's not a horrible situation to be in. Some people might even say it's a high-class problem, but it can cause challenges. I'm not saying anybody should, ask for a lower valuation. Of course not. But it is just something that investors should be aware of, board members should be aware of, and founders should be aware of. Right now, those high, crazy valuations we saw during COVID, they're gone. The companies that got those crazy valuations have returned back down to earth, whether it was DoorDash or Peloton, even Snowflake, the mighty Snowflake, which is a juggernaut and growing really fast, lost 10, 15% on the day we tape this. So you're starting to see like all of this compression in valuations, the public market, that makes its way to the private market. And it made its way pretty quickly. Yeah,
we experienced that from our side, especially from what we've sort of observed in Australia, that effectively you see that crossover where a lot of sort of high net worth and family office investors do invest in the small and mid cap sort of tech companies. And so when they're watching the valuations decimate, 60 to 80% across a few month period, obviously that does impact what then goes into the venture side.
Yeah, exactly.
Now, from your, if we're, as an investor, if we're to spend a day in the life of you, as far as from conversations you're having with investors, from conversations you're having with founders, from session interviews that you're doing, what are the observations that you're making outside of that valuation aspect? What are some of the observations you're making from trends you're starting to see, in areas that are starting to come up that you didn't see sort of 12 months ago, et cetera?
Well, the crypto hype cycle has been pretty violent, and you had a lot of scam artists and grifts in there, and I would say people who maybe can't execute. And we're starting to see on the margins, people actually finish their products or start to put some products in the market. And, that's what I've been waiting for, is a crypto project that had customers that were paying for a service. And we're actually starting to see the beginnings of that. And I'm not talking about a customer as in a speculator buying the coins, because that's really an investor or a gambler, one of those two, and not people buying NFTs because they have an affinity for them or they're speculating, or both, but actually making a reasonable business that is a tool or a product that people will pay for and get value from. And so that's the interesting piece I'm starting to see. And, we're just starting to dabble a little bit in crypto. Now, the valuations are absolutely illogical that a company or a project, you see projects become worth $10 billion, $50 billion, and they have 6, 7, 8 developers, and they've got a ton of coins, and people are buying the coins who have nothing to do with the project to speculate on it. They put 100 million or 250 million into some foundation, and the equity investors don't have equity in the company. Maybe they have some coins. The coins don't have any protective provisions, downside protections. Yeah. And maybe one group of people can sell the coins before the other. And then who becomes the bag holder? I mean, it's pretty gnarly. But I do think that there will be some interesting companies to come out of the crypto winter, and all these dead companies. It's going to, if what we do in angel investing is like 1 out of 10 companies or 2 out of 10 work, I think it's going to be 1 out of 100 in crypto projects. So your odds are going to be against you, and the entry price and the valuations are going to be 10x. So if you just think about that for a second, you get 10 times the failure rate. So only 1 out of 100 become an exit. And then it's at 10 times the valuation. Now we're looking at, 1,000 to 1 odds, basically, or, the value, the number of swings you get to take at bat is lower because you're paying 10 times as much to participate in these deals. So that's why we've, largely stayed away from them, because we can make 10 investments in a fintech, marketplace, consumer subscription, or a SaaS company, or a hardware as a service company with greater odds. So it's not to be a Luddite, but if the prices are too expensive, there's no protective provisions, and there's too many companies and not enough executors, I think that space is really suspect. But I am starting to see some interesting things. So I kind of feel like year 11 of crypto is year 1.
I was thinking about this before the interview, right? And I was thinking about your career. You obviously, for me, my perspective from when I observe you built your career off the back of Web 2.0 from the investment side, media profile, and so forth. So for you, I imagine part of this is it's like seeing it all over again, but just, and obviously for me, the identification, we didn't even talk about this last time, is Web 3.0 as an example being identified. So what, apart from the product aspect, and we're also seeing the same as well, actual real products. And for us, we even see companies just building opportunities on blockchain without tokens attached to it, right? They're just looking to basically make different marketplaces more efficient. What are the key signs that what are the observations that you saw from Web 2.0 that you're now seeing in Web 3.0? And you've identified the risk aspect. What are some of the opportunity aspects that could be, that investors could be on the lookout for?
Web 2 had a lot of talented builders leave established companies to really build, prototypes, minimum viable products. We really didn't have that name back then, MVP. But people were hacking and building small projects that then became very big, whether it was Dig or Reddit or Flickr or Delicious or Weblogs Inc., WordPress. There were a lot of people trying, Twitter, just trying to hack something together, put it out in the world and see if it caught any kind of viral uptick. And if people got value from it, if they became addicted to it, gamification was big, et cetera. And you were able to deploy these projects with very small amounts of money or no money. If you just had a designer and a developer, you could iterate and put something into the world. These crypto projects tend to raise tons of money, and the technology is generally, it feels like technology in search of a problem, and that's problematic. I think that is the challenge. When in the Web 2.0 era, people were really thinking about consumers and how to delight them and to get them addicted to a product, to get them in a viral loop, to give them value so they would keep coming back. Instagram was the easiest way to share a photo, and you didn't have to use Photoshop to make the photo look better. People forget, but back then, if you had a photo and it wasn't that good, if you wanted to make it look professional, you had to go get a digital SLR camera, upload the photo, and then maybe put it into Photoshop or Lightroom or whatever, and work on it for 20 minutes. And Instagram was like, yeah, just take a photo with your crummy iPhone or your Nokia camera and pick a filter. We'll do basically with these 6 or 7 filters what you were going to do anyway in Photoshop. And that just made it seamless, right? And that was incredible value. Now you compare that to a crypto project. They're like, we're going to use blockchain to make something that's not distributed. And you're like, okay, what is it? Oh, it's a not distributed version of Instagram. And you go, well, if there's no central person in charge, well, what happens when somebody posts something that is offensive, illegal, hate speech? They, put something terrible up there, stolen photos, copyright, otherwise. And you're like, well, the decentralization actually hurts you there. And then you're like, well, we're going to put it on an open blockchain and it's immutable. It's like, okay, well, you just put something on the blockchain that is gnarly, that nobody wants to see. Okay, that's terrifying. Actually, it's like a nightmare scenario. It's like a Black Mirror episode, if you know the Netflix anthology series, where like it's really dystopian. So what I found was there was a disconnect between the deployment and the use of the technology and the understanding of the user with this Web3 cohort. And I think there was so much focus on raising capital, finding bag holders, selling the tokens, selling the NFTs, that they put 90% of the effort into fundraising internationally, getting people to send crypto to a wallet, breaking all kinds of securities law, and then not on the user journey, not on the user experience, not on the user value, not on the joy or the pain, the joy you would add to a user's life, or the pain and suffering you would remove from it, which is really what Web 2 was about. Like, can we take out the friction and make life better? And so that's the problem with that whole category. And so, the idea of trading NFTs, what's the value here exactly? Okay, it's expensive. It's more expensive than doing it another way. And it's immutable. Who cares? Like, none of this stuff really actually matters in a lot of cases. And it turns out there is central, points of failure, even though people say there aren't. But then again, we saw with NFTs, well, wait a second. What if this NFT gave you value in, a Soho club or a membership or a Costco membership in some way? And then they deployed that capital to build the value of the membership, and you keep adding people. And then DAOs have some interesting concepts to them. Oh, should people in our syndicate vote on what we invest in? Well, they kind of are already, because they vote with their dollar. Either they do the deal or they don't. And then they pick how many votes they want to put towards it based on the number of thousands of dollars they put in. So there is something interesting in DAOs, I think. Would we want people voting when to sell a share? No, like they probably don't have enough insight into how to manage that. But there are interesting things happening there, but it's distinctly different because it's capital first and 90% of the cycles, and then 10% on the actual product. So that's why it's a problem.
I was going to say, what I find interesting is if you think about Web 2.0, it effectively created the network effect opportunity that has effectively allowed crypto to go global as fast as what it has.
And Web 1.0 did that for Web 2.0, just even having connections to each other, right? So, yeah.
And then how do you feel about, like, if you think about how Web 1.0 had its role and the value that was created from that, then you think Web 2.0, the value that was created of that, and then like you think about how, I'm sure, we both of us remember classifieds in newspapers, right? So we think about how that sort of how that value got replaced and then sort of expanded on top of that, and all the business models were created on the side. You start to think, what role could Web 3.0 instead? The actual theme of this conference is the exponential era of innovation. And to me, I think about that, firstly, that replacement value, but then what are all the other types of opportunities that get created on the fringe of this new layer of opportunity?
Yeah, I mean, built-in money is interesting. So if every application had cryptocurrency of some type built in, and you could very quickly, based on behaviors or interactions or things that occurred, some amount of money or commerce would pass through, and that's built in. It's kind of neat. Just like having Apple Pay on your phone is super fun. When you buy ice cream with your kids, and you don't have to take your wallet out, you just use your iPhone. It's delightful. So again, if there are things that make the user's life more delightful, great. But every hype cycle, I see the same thing, whether it's Web 1.0, 2.0, or now Web 3. People say it doesn't matter if you make money, it doesn't matter your profits. And then eventually the public markets say, you know what, we don't like Uber and Airbnb, they're not profitable enough. And then those companies have to all of a sudden change, and DoorDash and Instacart, they have to make a big shift because the public markets are saying, you know what, that's great that you were high growth in the private markets. It's great that people loved your product, whatever. It was up and to the right, but show us your unit economics. Show us this can throw off some amount of profits and cash flow, and we'll eventually value you based on the cash you're throwing off and your growth, like those two factors. And so, people want to live in a bubble. That's fine. If people want to pretend that the business realities, that gravity doesn't exist, that profits don't exist, that unit economics don't exist.
Milestones don't exist.
Milestones don't exist. Sure. Like have at it. But the old salty dog in me has seen this movie so many times that, when the market is hot, everybody's a genius and no amount of discipline matters. Then the market crashes like it has. And then all that matters is the discipline and the numbers you're putting on the board. And that's where we are now. It's important as an investor and a founder to be aware of this cycle, so you don't get caught in an updraft or a downdraft. And so I've had companies that they raised their seed round so easy that they never focused on their business model. And then 10 months later, they've burned through $3 million. And they're like, we're just going to raise our A. And they talk to 3 folks and they're like, yeah, this isn't a Series A investment. Your product's barely in market. The growth isn't there. The team has still got holes in it. And you're burning money. Like, I don't want to catch this knife. I'm not giving you $8 million. And they're like, okay, then I'll just go back to my existing investors and do what I did last time. The existing investors go, well, you didn't really execute well. So, and we're looking for somebody else to validate this investment. So you can't get the bridge done. So there's no bridge, there's no Series A. And now they're going out trying to do another seed extension, pre-Series A, or whatever term they want to do it. And they fail. And that's happening.
It's a really hard thing to watch people where they go from that. And I see this with founders a lot, where sometimes they feel like they're entitled to raise their round or entitled to succeed in a business. And you watch that harsh reality come forward where they realize that, hey, the idea just isn't enough.
At the start, I always tell founders, you're selling the promise. You're selling this vision and the promise. Then once you raise the money and you deploy it, now the community is going to look at performance. And if you're still in the theatrical promise phase and you're talking about all the vision you have and it's year 3 and no numbers have been put on the board and it's not growing and users aren't using the product, people are going to look at it and say, well, why don't you just fold the company and come up with another idea? This idea didn't work. And they go to an accelerator, they get a great seed round done, they maybe get a bridge done, and now we're in year 3 or 4 and nothing's changed really. And they try to go out and raise another bridge, and then it's like the community is like, yeah, why don't you just shut this down and get a new cap table and go back to an accelerator? And they had 3 or 4 years to get it done. And the tragedy is a lot of times I see them in the last 6 months get 5 customers to pay, but they spent the last year giving people free trials. And so it's like somebody's, got this great jet airplane. They're flying it. They're going super fast, but they're flying too low and they run out of fuel. They're not watching the fuel gauge. And then they're like, wait, we're at 10,000 feet. We should be at 35. And they're like, oh yeah. And by the way, we only have like 100 miles of fuel. And it's like, yeah, the runway is 300 miles away. So where are you going to land this plane? You're not. You're going to ditch the plane and everybody on it's going to go up in a ball of flames. And this is going to be a complete wipeout. And so I try to get founders to look at the instrument panel. How much money do you have in the bank? How much money you're burning? What is your 18-month, 24-month plan? Hopefully you made a 2-year plan. That's 100 weeks. That's 8 quarters. It's 24 months. And you have the staffing that you need and the revenue you need and a waterfall and proper accountants to look at that model and say, hey, this is a reasonable model that we can execute against. And, I'll talk to a founder and say, listen, I say, hey, what's the plan here? And they're like, well, we're hoping to do this. We're hoping to do that. And I tell them what Doug Leone from Sequoia told me. He said at some point, Jason, hope is not a plan. A plan is a plan. So let's stop hoping and make a plan. And then we can always change the plan, but a plan is a plan. So let's make that plan. Let's execute against it. But we can always change it. Sure. We can make it bigger goals. We can lower the goals. But if you're executing against a plan, that's like the pilot who's constantly looking at their dashboard. They know their speed, they know their fuel level, they know their altitude, and they know where the plane's going to land if something goes wrong and they lose an engine. And they're just cognizant of all of that data. And then I got folks who are going to conferences and hosting dinners and doing anything but working on their core product. And I'm just like, wow, this founder is so distracted. They're distracting themselves all the time with shiny new objects and things that don't matter, things that are not their core business. And, they're not paying attention. And then they get into the soup, as the pilots call it. They get into bad weather. Bad weather is going to happen. And now you don't know how to read the instrument panel. You don't know how much fuel you have. You don't know your speed. And it's windy and there's turbulence and you can't see and you crash into a mountain. It's totally avoidable. Yeah. I'm obsessed with watching these aviation videos of why planes crash. And my Lord, every time this Blanco Lirio channel I watch on YouTube and I support on Patreon, it's like 9 out of 10 times there's some sequence of pilot error that is so easily avoidable that everybody on the plane would have survived. And that's really what it is with founders. And that's why some people love to invest in second or third time founders and they just avoid first time founders. I love investing in first time founders. And I love just asking them really good questions. Have we made a plan? Do you need help making a plan? What's our burn rate? When will we cash out? What's our unit economics? How much does it cost us to acquire a customer? Have we looked at our cohort analysis of the people we acquire through the sales channel, through the marketing channel, and organically and self-serve, and figured out which one lands and expands and which one churns of those cohorts? And they're like, what's cohort analysis? What's a plan? How does that work? And I'm like, great. Here's a document on how to do that. Here's a Notion page. Here's a Google sheet. Here's an Excel that you can fill out and try to figure that out for yourself. Or here's a podcast. So I really enjoy that part of the job. Is trying to help the founders not crash the plane. So for you, of succeeding.
So for putting your investor hat on, love to understand where obviously you see a lot of deal flow. How do you form, when you're forming your investment thesis, is it on a day-to-day basis, or is it like you gave your, of sort of what you're talking about, your holiday in Italy when you start writing a book? How do you take yourself away from everything to think about, okay, what is my focus for the next sort of 12 months, 24 months? Where does that sort of thinking come from, and how do you arrive at your investment thesis?
So I like to think in decades and how I run the business. And my recent thinking is we should try to triple the dollars deployed because we did that. I think we tripled or quadrupled the number of dollars from 2020 to 2021 in the syndicate. So I said, okay, let's just go with doubling into 2022, double in 2023, and double in 2024. And I'm actually building a 3-year plan to double the amount we deploy. And there's different ways to do that, more pro ratas, larger allocations, or more deals. And I started to make a plan around that. And so I'm thinking about my second decade, making the Syndicate, which is the largest individual angel syndicate in the world with 9,500 members in one syndicate, which is almost too many because sometimes we often fill deals and we're oversubscribed. But I'm really thinking about that as a plan. And then I have to think about, well, how many meetings do we have to take? If we're only investing in 1 out of 50 companies we meet with, and each of those companies we meet with is 5 decks we reviewed and didn't meet with, you start to get the idea that it's 250 inbound to one, company getting a check from us. You're going to need a lot of researchers, a lot of deal flow to do that. So there's those mechanics. But then when it comes to companies, when it's a small check, we have a founder university program where we write 25K checks into companies just to help them get started. We have an accelerator, the Launch Accelerator, where we put 100K in, like Y Combinator Techstars do for 6%. And then we have seed rounds and Series A and pro rata. We will take different amounts of care and with the different bet sizes. When we put a 25K check in at $1 million valuation for somebody with an idea and a prototype, our expectation is, 19 of 20 are going to fail. Like it's going to be 5% are going to make it to the other side. But that's okay because it's such a small amount. Then in the accelerator, well, we want more than half of them to get funding. And that's a pretty good sign that we're doing a good job. And then when it comes to seed investing, if we're putting in 750 or $1.5 million, we're going to want a board seat. We're going to want to have information rights. We're going to want to have pro rata, all these other mechanical things so that we can increase our ownership in the winners. And so we really think about increasing our ownership in the winners as a way to make up for all the mistakes. This is classic venture theory, but we will do super pro rata. We'll ask to increase our percentage ownership when a company is tripling revenue year over year on a decent number. So if the company had 50, let's say they had in Q1 of last year, they had 100K, and this year they have 400K. They 4X'd year over year. We own 6% of the company. We might say, hey, in this new round of funding, we'd like to get to 10% ownership. Can we get an allocation that gets us there? Not just our pro rata. So if you're raising 3 million and we own 6%, okay, we got to put up, a certain amount of money to maintain that 6%, be 6% of the 3 million or 180,000. We might say, hey, we really want to get to, more like 10%. So can we put in 500K or something? We'll try to increase that percentage, right, as we go. And,
for the company side, what sort of, you mentioned about the year-on-year growth aspect. What would be your minimum year-on-year growth that you're looking for?
It's all situational, but I would define high growth as in an early stage, tripling, quadrupling, or better. That'd be high growth. And I would want to consider, you have to look because maybe they're doing consulting and not selling SaaS software. So you really want to make sure you understand the revenue picture here. Maybe they did a conference and that threw $1 million to the bottom line. They only have 100,000 in SaaS revenue, right? So you just want to make sure you understand what's going on there. But if the revenue is tripling, quadrupling, or more, we probably would want to expand our position. If it was 2Xing, 1.5Xing, they had the 100K last Q1 and now they're doing 200K, maybe we'd want to do our pro rata, maintain our position because it is growing, but it's not growing violently. It's not growing like a high growth startup. But we still want to be in the game with the founder because it's growing. Yep. And then if it's not growing, we have to ask ourselves, why? Did they pivot? Okay, great. Is the new pivot going well? Great. So you're kind of resetting the clock. If they were at it for 18 months and the pivot occurred 6 months ago, okay, well, we'll throw away year one. Let's just look at the 6 months. Okay, is there some reasonable growth here that we can identify to continue to go pro rata? Or maybe we'll stand pat. Standing pat is when in poker, you don't put any more money in the pot. We'll just stand pat where we are. It's kind of like checking in a way. So we'll just stand pat and say, hey, listen, it's, you have to get other investors to prove this out. Now, if another investor is Sequoia or Kraft and David Sachs or Chamath or somebody like that, we might say, hey, that's a pretty good signal. And they are going to bring a lot of value and they're bringing, great governance and a great board member. Okay, that might be a reason for us to do our pro rata or super pro rata or ask for super pro rata. So generally, you want to save your dry powder for out of the 40 companies in your last fund or 100 companies, whatever the number is, the top 10 or 20% that are objectively growing the fastest. And so we try to communicate that to our syndicate. We try to communicate that to our founders. If you're high growth, we will try to increase our ownership if you'll allow us. If you're high growth and we can't get additional ownership, we understand. We'll just do our pro rata.
It's interesting. You mentioned about from the investor side, as far as looking to take up, looking to participate more and more. Obviously, I find that dealing with a lot of, sorry, just nudge my table, dealing with a lot of companies, they get so hung up on that sort of first amount of capital from an investor, not thinking about the potential. And I found that in my own sort of experience that often the raising capital process looks like this over a period of time. What would be sort of guidance that you would have for founders when they are sort of facing their challenges, or getting frustrated, or going through the emotional journey of that sort of first or second round of raising capital?
Raising capital is a full-time job, and it's a numbers game, and it's a performance game. If your performance is up and to the right and you're tripling revenue year over year, you're going to get funded in all likelihood, because you're certainly going to get 9 out of 10 meetings. What investor is not going to meet with a company that tripled revenue year over year? So if there is a way for you to block everything else out and triple the revenue year over year, or quadruple the growth, or 10x the growth if it's a free product, and 10x the engagement, that will do more for you than any amount of introductions from me or another famous investor. Will do more for you than any amount of press or any amount of gorgeous pitch decking. Performance is the ultimate draw for an investor. You show them that chart, it's up and to the right. They're going to take the meeting. They take the meeting. And if it checks out, they're going to give you a term sheet in all likelihood. If that's not the case, the first step is, can you get there? And if that's not the case, you're not going to get there. Well, then you're going to have to sell some promise, or it's going to be a numbers game. So let's say you're in the situation, you made that $100,000 in Q1 of 2021. It's now Q1 of 2022, and you've made 200,000. So you doubled, but it's not high growth. Well, then you're going to have to meet with 3 times as many investors, because maybe half the investors won't even take the meeting. So your first emails and all the introductions are going to be less effective. Again, if you have that incredible growth and I introduce you to 50 investors, you're going to get 45 meetings, more than enough to get to 20-second meetings, 7 third meetings, and 2 or 3 term sheets. Now, if you're not growing that fast, you're growing slow, and you are, I introduce you to 50 investors, you're going to get 25 meetings, which means those 25 meetings are going to turn into maybe 10 second meetings and 3 third meetings, and maybe no term sheets. So you can really look at that pipeline. You can think of that pipeline like a funnel. And now I've got to get you, or you've got to get introductions to more like 100 or 150 investors, 150 investors to get to 50 meetings, to get to 20-second meetings, to get to 7 third meetings, hopefully if you clear market.
Now, we, as part of this, and obviously I always love that we can provide advice for both founders and investors when we do this. So we did some crowdsourcing of questions. So
Great.
to sort of go through the
lightning round.
Yes, the lightning, pretty much. The first one is, which investment did you get the most wrong? This space always likes to talk about winners, but
before I was angel investing, I was just helping some friends with their fundraising and introducing them to investors. I didn't have the money to invest, and I was, behind the 8 ball, in terms of my net worth. I was like actually in debt and trying to buy a home and getting married, all this stuff. So it was a bit of a mess for me, but I did help my friend Mark Pincus meet investors for Zynga, my friend Evan Williams meet investors for Twitter, and then my friend Elon and forwarded like this crazy electric car company people. I didn't invest in any of those. And those would have been 3 amazing, extraordinary investments for me. But shortly after that, Sequoia said, listen, you're helping all these other people with these investments and just introducing them because you know so many people. Would you like to become a scout for us? And so that's when I got the Uber, the Thumbtacks, and countless other investments. So, before I was an investor, I probably had the opportunity to invest in, a dozen unicorns, and I just wasn't in the game at that time. And that's why once I did get a taste of it and I got in the game, I said, wait a second, putting 25 or 50K into these companies is great. How do I get to 250, 500? And now it's how do I get to 5 million? And so we just closed a pro rata in a company. We did the $4 million round, and we had 6% of the company. They raised 100 million, they're worth $1 billion. Our pro rata was 6 million. We filled 6.6 million, I think. So we went super pro rata at the $1 billion level. And so that's something I think for investors, as you get good at this, being able to put more money to work in the winners is the absolute key. And that's what we're doing now. We would own under 1% of Uber, Thumbtack, et cetera. Then we own 2% of Superhuman. 5% of comm, 5 or 6% of density, and then all of a sudden 12% of Grin, 15% of Fitbod, these other great companies that started to become worth 9 figures, we started to own over 10% of them. And that's really where, you start to get to 9-figure positions. The company becomes worth $1 billion and you own 10% of it, you got a $100 million position. And that's when the magic happens.
On a personal note, what a life-changing product is Superhuman.
Incredible. We were the investors, our first investors in Raul's first company called Reportive, which was a sidebar for Gmail that showed you the person's social media accounts. And that got bought by LinkedIn, and we tripled our money on that deal. So I think I had to put $50K in and got $200K back or something. It was nice. But I always told Raul, listen, I think you're brilliant. If you ever do another company, fine with you selling to LinkedIn, but please let me be the first investor in the next company. And we were amongst, I don't know if I can claim to be the first investor in Superhuman, but I think he let a group of his existing investors all into that same early round. And I think we put $500K in immediately on the crazy idea of taking on Gmail, because that was just a founder bet, and it's worked out very well.
Okay, next question. Actually, my next question was going to be your anti-portfolio, but you sort of covered that with the first question. Next question I got is, what is the single most important quality you look for in a founder?
Yeah. You have to be high energy and have resiliency and grit. I think most people look for that resiliency, grit, drive. Those are what most investors would say is the most important. Certainly, the ability to build a great product and to get people to join you on the team, also important. I very rarely see somebody who's got a ton of grit, but they can't make a good product succeed. So grit alone is not enough. You have to be able to recruit, and you have to be able to build a great product. So I think people who are builders and who have grit, that's really what I'm looking for.
Yep.
If you've got a lot of grit, you're not going to give up, and you've got that product velocity and that product vision, you're going to keep building it. The actual ability to build the product matters. That's why Y Combinator is always looking for 2, 3, 4 founders, and 2, 3 of the 4 founders to be developers or designers. They don't want solo founders. They don't want idea people or leaders or salespeople. They want product developers, product managers, designers, UX designers, and developers. That's who they invest in. That's a big part of their success, is they have pretty good discipline around that. Some people might say it's kind of exclusionary in some ways, but I think it's very pragmatic. Builders build, talkers talk.
Great suggestion. Okay, what sector excites you the most over the next 12 months?
There's a couple of sectors I really like. I look for the founders to tell me what to be excited about. I look at their excitement, and then I channel that. The sectors generally don't have names until they've been successful. So on demand as a term didn't exist until Lyft, Uber, DoorDash, Postmates, Airbnb started providing things on demand. And some associate named it, at some venture firm named it on demand economy, whatever, in year 5. So I try not to worry too much about the sector names, but there are business models and there are, broad verticals that I think will always be really compelling. Fintech, anything to do with financing, financials, banking, et cetera. Marketplaces, SaaS companies, and then consumer software or consumer subscriptions. Consumer software, could be Instagram or Twitter, software that you use to communicate or do something, but you're not paying them. And then consumer subscription, Netflix, Spotify, Steezy for dance, Musician for music, other apps like that. So we like those 4 or 5 categories.
Anything specific in B2B that you find interesting?
Yeah, so B2B, I put as SaaS. And so, any and the ability to pay for business software on a monthly or per seat basis creates a purity for the founders and the customers. Either you're getting value or you're not. And that's why some subscription companies like to play games. You got to call us to cancel. We don't send you the bill. It's hidden in the interface. And then other folks will just send you the bill every month and remind you of what you paid. And then there'll be a button on it, change my subscription, cancel my subscription. And so that is the beauty of it. When you see people churning, you can know why. And when you see people expanding, you can know why. Oh, Slack was doing really good in this company. in the developer group, and the designer started using it, and then HR started using it, and the sales team started using it, and we saw this path. Okay, great. Let's get more developers to use it. Oh, or HR is using it. Great. What does it work well for HR? Let's target HR people. So you can kind of get that great feedback loop. And the same is true for any subscription. If Netflix people start churning because they're getting Disney Plus or Hulu or HBO Max, you can say, what is HBO Max doing? Oh, they're doing original series. Great. We got to do that. Oh, Disney's doing franchises. Okay. Maybe we need to consider that. Maybe we need to have some of our own franchises. So there's a purity to subscriptions that I really like that business model.
Okay, next question. Have you made any investments into Australian companies recently?
Yeah, we did Cake, which is a cap table employee stock option plan management company.
We also use them and are big fans of Jason and the team at Cake.
Solid team. And we got our feet on the ground. We're constantly getting a good amount of deal flow from Sydney and Melbourne. And
fantastic.
We like it. Yeah.
And what about the UK?
Europe, not so much. We find, a lot of the founders who are in Europe will move to the United States to pursue their dreams because there's a better funding environment, more talent. The Scandinavian countries, the Nordics are a notable exception. They seem to have figured out how to support founders. The rest of the EU, they really put up a lot of roadblocks. If you hire people, you can't fire them. Or if you do want to fire them, you got to give them a year or 2 or 3 years severance. And that lack of employment at will, it just makes no sense. And it's not conducive to entrepreneurship, because the whole idea here is you could start as a B2B company and need a sales team and then realize nobody wants to pay for it. So you're going to move to the advertising. So you got to let go of the B2B sales team. You got to let go of 8 people. Now you can't let go of them. You got to pay their salary for a year. And I get worker protections, but these are like knowledge workers. They don't need protection. They've got countless job offers. We're not talking about factory workers and you're shutting down a plant and now everybody's got to move their whole family to another town with another plant. So those are antiquated laws and they don't really apply to knowledge workers who can just the next day, they've got 5 job offers hanging out there every month. So you really want to have that fluidity of the US market, which is employment at will. Either side can end the employment for any reason or no stated reason. I can just wake up tomorrow and if I was, Uber or Lyft, I could say, you know what, we're going to be out of this business. We're getting rid of this 6th business we're doing. Everybody's going to get a nice severance package and we're done. We wish you well. We'll help you get jobs, but we all know they're going to get jobs immediately in this kind of market. And it's been like that for the last 30 or 40 years. There's no knowledge workers who can't get a job. So that's why Europe is really like turning into a retirement community and a museum. And listen, I love going to Italy. I love going to Paris, but investing in those places, not so sure it's a great investment because of the fact that the countries are not supportive of the
So from our
process.
perspective, like working a lot in the UK over the last sort of 12 months, it is actually incredible to see the amount of funds that have, effectively they do have a good infrastructure for funds. They seem to have a lot of different angel networks, syndicates, and also the massive amounts of accelerators, etc. As far as the environment for fintech, it seems, and also from a funding growth perspective in 2021, I think they had 100% plus increase of money going into venture companies, which I found really interesting.
Yeah.
So as a next question, this is more of a founder related question. What's your greatest piece of advice for founders seeking strategic investors?
Finding strategic investors or taking them?
Seeking strategic, finding them, and I suppose taking them as well.
Generally a terrible idea, because strategic investors want to own, compete with, or stop other people from owning your company. So if Facebook is investing in your company, let's say theoretically, it's because they see you as a threat or a company that might be a threat someday. You don't want to take their money. You don't want to let the fox in the hen house, as it were. So that's generally a terrible idea. Sometimes on the margins, you can get a small investment from a company like that. No information rights, no board seat, et cetera, be fine. But yeah, they generally do it as a blocking strategy or a preemptive strategy. So I think it's also a sign that your company is weak or you're weak as a founder if you can't get the venture community to invest in your company. The venture community has pure economic reasons. The stock price is going to go up. You're going to let us buy shares for $1. You're going to get it to $50. The strategic says, oh, this could interfere and reduce the margin of our big money-making division. Let's buy the shares for $1 and let's buy all the other shares for $2. And let's shut this company down or get them to work for us. And then we'll grow it to $5,000 a share as part of our big, huge valuation. So it's a terrible idea.
Have you seen scenarios where strategic investors have added value to the companies, and when you've sort of looked at it, thought, okay, I'm going to pass on this, but then maybe you've seen strategic investors go in?
There are some where, like, Samsung wants to get content or apps for their TVs or for their phones, and they're not going to be in the content business, nor are they going to be in the app business. They want to just goose the ecosystem and get the flywheel going. That's fine. If YouTube wants to give grants for content, TikTok wants to give grants for content to get the flywheel going, or some app stores coming out and they want to seed it with some great apps and they'll give you a strategic investment, I don't see a problem with that. They're doing it to build their ecosystem. Those ecosystem strategics is a notable exception.
Okay, and I'll go final question. When you're thinking about the next 5 years and you're thinking about investments you're looking to make over the next 5 years and the outcome sort of from that, or I suppose sectors that you're looking to go into, what sort of goes through your mind as what you believe could be the winning, whether it be technology platforms, sectors, or area, and as though some may not exist right now, but could be potentials over the next 5 years?
So again, I don't bet on sectors. I bet on founders and their ability to build products that delight customers. So there are things that I've seen delight customers, removing pain from their lives, adding joy to their lives, making them laugh, giving them more choices in life, making them feel more supported, coaching, content, communities. All of these things can, software to make working more efficient. So I try not to think about sectors. Now, in terms of technologies, sometimes technologies can bring, like mobile did, a whole nother set of ideas into existence. So Uber previously had existed as, I think it was Taxi Magic or something. You call a phone number, you text. So 800 numbers were like the original mobile technology, then text messaging, then apps. So if you look at that progression, kind of text, building things on text messages or 800 numbers did work. There were billion-dollar businesses. 1-800-Flowers comes to mind, where the 800 number, a free phone call, was the latest and greatest technology. You get a good one of those, and my Lord, you're great. Then domain names in Web 1.0. Oh, somebody had travel.com or hotels.com.
I remember people having domain funds, like portfolios of domain.
Great idea, actually. They're incredibly appreciating assets. A domain fund probably over the dot-com era into Web 2.0 would have performed better than most venture funds, in fact. Probably would have seen 10x returns, 20x returns overall because of scarcity. So, there are new technologies that come out that start everything over again. Most people would say right now, there are things in Web3 that could do that, but we actually haven't seen that happen yet. So I would reserve judgment, with the exception of art and NFTs. That does seem to be disrupting the art space. Like when you see Sotheby's doing an NFT auction, that money buying NFTs is money that could have been buying regular paintings. So I'm not sure if it's all accretive. It could be some new buyers, but I do think some of the old money going into paintings might be going into NFTs, actually. So that does seem to be, one example. And I do think AR, augmented reality, in another 5 years, we'll start to see some companies. So actually now might be a good idea to start looking at AR companies. VR, I feel, is a bust of a technology. It's kind of like a milestone on the way to AR, augmented reality, or XR, where you're kind of looking through your glasses and, information is being overlaid onto the real world. I do think the look through AR is going to be very powerful. And so, maybe you could start looking there or dabbling. I think dabbling is a wonderful thing to do to learn. So if you wanted to learn a new poker game, you don't know how to play 7-card stud or Raz or PLO high-low, play at the smallest possible game where you buy in for $50, lose $50 10 times, over 10 hours. And now your cost per hour of poker lessons is $50 an hour. Brilliant.
Love the way you think about it.
Yeah.
Well, Jason, just want to say thank you so much for your time.
My pleasure.
I really
Thanks
appreciate
for hosting
it.
me again. Yeah, my pleasure.
And my last encouragement is I was talking with Presh before about your launch festival and how you hosted across 2 years in Australia. So
I loved it.
Obviously, I'd highly suggest for you to bring that festival back out to Australia sometime.
If there's any city, there was a little tension between Melbourne and Sydney. They both wanted it last time. Melbourne, maybe this is your opportunity. Sydney's sleeping. Maybe
Launch Victoria. That's a shout out to you.
Yeah, anybody. I mean, we'll do it in Perth. We'll do it anywhere. Listen, personally, I love coming to Australia. With the COVID and everything, I really miss it, and I would love to get back to Hamilton Island, the Great Barrier Reef.
I just want to do my best to give you an excuse. So we're happy to help in whatever way we can.
Yeah, I can't wait to get back out there and scuba dive with some of those minke whales and some of those bulls. You got some nice bull sharks down there, sort of a couple of whites.
Some people have them in their backyards at the moment because of the flooding, but
yeah, no, I don't want to. Yeah, and if you're scuba diving, okay, just don't stay on the top of the water too much. My best advice. That's where they look for lunch. If you're at the bottom, you're okay. Top of the water, not so much.
Thanks so much again, Jason. Really appreciate your time.
Can't wait to see everybody down under soon.
See ya.
Cheers now.